Hello again, and welcome to the Reading Charts module of the Expert Trader course. In this module, we're going to talk about a variety of charting methods. We're going to discuss technical indicators. We're going to start talking about how to actually read the markets and understand what's going on within them. And especially, we're going to start talking about understanding trends, which is going to be an extremely important aspect to your trading. Now, there are a lot of different ways, actually, to do charts, but the most common in the United States up until the late 1990s was what's called bar charts. But there was something called candlestick charts that actually started in Japan in the 1800s, and it was pretty much not widely known outside of Japan. But these days has become extremely popular and is in basically every trading platform and is generally our preferred style of charts. Now, candlestick patterns. This is something I'm going to talk a lot about, but it's critical that I make this point. They never, ever should be used alone. You never, under any circumstances, take a trade based solely on a candlestick or a candlestick pattern. Do not do that. You have to use these patterns, everything we're going to talk about with candlesticks, along with all the other techniques that we're going to be talking about. So make sure that you understand that candlesticks are not a holy grail. They are not the be-all, end-all of everything, and you should never take a trade based on only the candlesticks. I really want to make sure that that point is clear. Now, that being said, let's start talking about candles. This is what they look like, more or less. They generally are, by default, in most trading platforms, either green or red. A green candle is considered to be bullish, and that is because the price went up. I'll talk more about that in just a second. A red candle is bearish. That is because the price went down. Now, I want to make it very, very clear, though. The point here is that green candles do not mean buy, just as red candles do not mean sell. Okay? These colors are just there to show you that for whatever period of time you're looking at, if it's a daily chart, then this is one day's activity, for example. It's just telling you whether that day was up or down. Okay? Again, I want to make this point. Never, ever react to a candlestick without considering all of the other things that we're going to teach you. This is extremely, extremely important. All right? Now, I do want to talk about the elements of a candlestick. So we have the wick. That is this line that is poking out above and below the candlestick. That's called the wick. Okay? Now, the colored part is called the body. So this is a green body. And this, well, you can't see the red dot on a red candle, but you get the idea. This is a red body. So this is the body of the candle, and these are the wicks of the candle. You have an upper wick and a lower wick. Now, what this represents, it tells you actually a lot of useful information. Namely, the top of this wick is the highest point that price got for whatever period of time this candlestick covers. Again, if we're looking at a daily chart, then this candlestick represents a full day's activity. So during that day, this is as high as it got. Now, on the other side is as low as it got. So during the day, this is the lowest point that price reached. It did not get any lower than that. So right away, you can see the high and the low of, in this case, the day, if it's a daily chart. If it was a 5-minute chart, then it would be for a 5-minute period of time. Now, the body will change color based on where the open and close price are relative to each other. So again, let's just stick with the daily chart because it's probably the easiest to understand. In this case, since it's green, it means that first thing in the morning, this price opened right here at the bottom of the body. This was the opening price. And at the end of the day, we had the closing price. So this point right here was the closing price of the day. Okay, so the pattern during the day was first thing, opening bell, price was here. Then somewhere during the day, we don't know when, we can't see that on a daily chart level, but somewhere during the day, it got as low as here. Somewhere else during the day, it got as high as here. And then at the close of the session, it was here. But because it closed higher than it opened, then the candle is colored green. Now, a red candle, same thing with the high and the low, but the open and close are reversed. It's red because it closed lower than it opened, right? So the whole flow is first thing, opening bell, price was right here, the top of the candle body. Then somewhere during the day, it got as high as here. Somewhere else during the day, it got as low as here. And then at the close of the day, it was right here. So since it closed lower than it opened, it is drawn as red, and that is a bearish candle versus the green, which is bullish. Now, here's kind of what they look like. This is an example of a chart, and you can see they come in lots of different shapes and sizes, right? We have this textbook illustration here, but in reality, candlesticks take on all kinds of different shapes, and you can see some of them here. And all of these shapes actually do have meaning. They all tell you something important about what the participants in this market are doing behind the scenes. So you can kind of see through price. It's sort of like X-ray vision. Now, if you have a really long wick like this, okay, that suggests failure of, in this case, the sellers to push the price down. All right, that's because during this period of time, which in this case, this is it's hard to see what that is exactly. I think this is a 60-minute chart. So for that 1 hour, sellers tried to push the price down, 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 down. They pushed it down as hard as they could, and they just couldn't hold it. Before the hour was up, buyers had shoved the price all the way back up again. So you can see it really clearly here. We've got failure to push the price down, and then the buyers came in. So this long wick shows you significant buying activity. And when you see that after there's been a downtrend, that shows you that there's serious buyers at that level. And sure enough, they bought it and then bought the price up, and then a new reversal began. A new trend began in the upwards direction. But you never ever react on just the one candle alone, right? This is only a potential reversal. It is confirmed by the next candle. If you see price come down, 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 down like this, and then get shot back up with a huge long wick, then you watch the next candle. If the next candle is also bullish, in this case, to the upside, then that suggests, okay, reversal is confirmed. Now you need to also layer that with your other techniques that we're going to be teaching you. You need to be looking at your buy and sell zones or your Dow theory, other things that we're going to talk about. And if you see a number of factors overlap and they're all coinciding in the same place, then that gives you a lot of confidence that it's time to take the trade. But again, I just want to remind you, you never ever trade on just the candlestick alone, not even with the confirmation. Just because you see this, if you're looking at nothing else, you do not take that trade. You need to see it in the context of everything else that you're looking at, all of your key levels and price zones and all this kind of thing. Now, candlestick patterns tell you very certain things about what's going on within the market. The patterns that we pay the most attention to, and there are hundreds, maybe even thousands of different candlestick patterns. You could get lost in them. But the only ones that we really care about are generally the bullish or bearish engulfing pattern, the hammer or inverted hammer, also sometimes referred to as a shooting star, and another pattern called dojis. And I'm going to show you all of these in just a moment. When you see any of these patterns happen at key price levels, it can suggest that the buyers or the sellers have just plain run out of steam. They don't have any more energy in them to keep buying or keep selling. And that is what causes a reversal to shape up, is when the buyers or the sellers, one or the other, has just given up. But again, I'll say this over and over again, these candlestick patterns must be seen in combination with other factors, okay? You'll never ever act on a candlestick pattern alone. You have to see it coincide with other things that we're going to teach you. Now, let's also talk about trends, because this is an extremely important component of trading, and you've got to understand how to identify a trend, and you need to get good at this. And it sounds so simple, right? Identify a trend. Well, look at it. Is it up or is it down? It's simple, right? But there's more to it than that. Specifically, if we are going to define a trend, what exactly is a trend? An uptrend is defined as a series of at least 2 higher highs and higher lows, right? So here we have a low, right? The market came down, 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 and it stopped falling there. And then it bounced up, and then it formed the first higher low, right? Because this low here is higher than that low there. So this is the first indication that, oh, maybe a trend is starting, but it hasn't started quite yet. All right? The first thing that needs to happen for the trend to actually officially have reversed is it needs to break above the previous lower high, right? Because the market will come down, it'll make low, lower high, lower low, lower high, lower low, lower high, and then it finally makes a higher low, and then it breaks the previous lower high. At that point, it can be said that the bullish trend has started. All right, but by the textbook, we don't technically have a bull trend until we have at least 1 higher high and 2, this is the second higher low, right? And now we have 2 higher highs. So here is 2 higher highs and 2 higher lows. At that point, we can say definitively a bull trend is now in effect on whatever time scale we're looking at. The reason it needs to be 2 is because you could easily have a market do this, form a higher low, a higher high, a higher low, a lower high, and then a lower low and lower high, lower low, and then keep on going down. Okay? So you need to, by the textbook anyway, you need to see 2 higher highs and 2 higher lows in order to define an uptrend. Now a downtrend, right? Same thing in reverse. You need at least 2 lower highs and lower lows. So same thing, you have market going up, higher high, higher low, higher high, higher low, higher high, higher low, then it makes the first lower high, right? Lower than the end of the move. It stalled out here, and then it fails to make a higher high. At that point, when it breaks the previous higher low, then you know that a reversal is potentially taking shape. And then you need to see, you have the first lower high already, you need to see the first lower low, the second lower high, and then the second lower low. Now, a downtrend is confirmed. All right? Now, we're not talking anything yet about taking trades. Okay, this is just trend recognition, trend definition. You will find after you understand these techniques, and you've been doing this for a little while, that you don't wait until all of this has happened before you take the trade. You will start to recognize when this is shaping up, and you'll probably take a trade somewhere around in here. But for the time being, just understand the textbook definition of an uptrend and a downtrend. Now, bullish engulfing is a pattern that we look very carefully for. It's a very powerful pattern when you see it at a key price level. It consists of a small red candle, right? Because it's a bullish pattern, so it needs to be happening in a downtrend, right? So the market is coming down, 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 making a series of lower lows, lower highs, lower lows, etc. It's a downtrend. And then all of a sudden you get a low, a down candle, a red candle, and the very next candle is a large green candle that literally engulfs the prior candle completely. Totally engulfs the whole thing. That is a bullish engulfing. Okay? Now, when you see this at a bottom, so price comes down, 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 and then all of a sudden you see that, it suggests a potentially significant reversal is forming. Right? But you need the next candle to confirm that. So price comes down, 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 down. You get a bullish engulfing, and if the next candle also continues to be upwards and holds that price level, then you've got a confirmed reversal. And again, when you see that in combination with key price levels, buy and sell zones, other things we're going to talk about, then you know that there is a potential trade opportunity. Now, a bearish engulfing, same basic idea, just flipped around, right? So price is coming up, 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 and then all of a sudden you have a red candle that comes out that literally engulfs the entire green candle that came before it. Okay, but just like with the bullish engulfing, you need the second candle to confirm for you that the reversal has taken place. So price goes up, 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 up. And then we have a big engulfing bearish candle that engulfs the prior candle. And then we have confirmation from the next candle. Now, the more candles from the past that this engulfing candle engulfs, the more significant, the stronger the reversal. And sometimes you'll see that. You'll see price come up like this, and you'll see an engulfing candle that engulfs 2 or 3 or 4 prior candles. That is a much more significant reversal, much more powerful reversal when it is then confirmed by the following candle. You always need that following candle as confirmation. So I want to make that point again. Bullish or bearish, either way, any candlestick pattern, you never react just because you see this, okay? Just because you see an engulfing candle come out, you don't just jump into a trade, even if it's at a key price level and all that kind of thing, because you don't yet know that it's confirmed. What happens if price is coming up, 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 you get an engulfing candle, and then the next candle shoots up again? Well, then the engulfing is canceled, is the bottom line. That has been negated. So you need to wait for the following candle to confirm the move so that you know exactly what is going on and what you're going to do about it. So this is another pattern called the hammer, and it is also a bullish pattern, and it consists of just a single candle, okay? And it looks like a hammer, right? That's where it gets the name. It looks like, there's the head of the hammer and the handle of the hammer, and you look like you want to, go hit some nails with it or something like that. But the key point here, the idea behind this, is that it's a long wick and then a small body up at the top. It is specifically meaningful at a trend bottom, okay? Because this is a bullish pattern. And the reason it's meaningful at the bottom is because price is coming down, 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 and then the sellers managed to push price all the way down to here, right? All the way down to this low point. But then the sellers just had no more steam left. They had no more power at all to keep the price down, and they couldn't do it. And buyers came rushing in and pushed the price up. Now, if you see a green hammer at the bottom of a downtrend, that is additionally bullish, because that means not only did the sellers run out of steam down here, and not only did the buyers push price all the way back up to here, but the buyers actually kept pushing the price all the way up, and the buyers held the price until this period closed. So again, if this is a daily chart, then that means at the end of the day, buyers were winning. Buyers held the price up here. Now, in the case of a red hammer at a trend bottom, that is still bullish also, just not quite as bullish. It means that sellers pushed the price down, 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 ran out of steam, couldn't hold it. Buyers came rushing in, pushed the price back up again, but the buyers were only able to push it up to here. All right? So at the end of the day, the sellers were still winning, but not by much. It's a close fight. In both cases, though, you still need that next candle as confirmation of the direction change. If price is coming down and it hits a key level and you see a hammer, and then the next candle reverses, starts coming up, then you know a reversal has taken place. But if the next candle starts just continuing down, then the reversal is canceled. Now, the inverted hammer is, as you might guess, just a hammer turned upside down. Okay, it is the same idea as the hammer pattern, but it is a bearish pattern, so it only really matters at the top of a trend move. This is also referred to as a shooting star, because the idea is that this is the star, the shiny part of the star, and then this is the tail of the star poking up above the price. So it's a bearish pattern, meaning price was going up, 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 and then the buyers just ran out of steam completely, and the sellers came rushing in and pushed price down. Now, if you see a red one, it means that at the end of this period, sellers were winning. All right, the sellers not only pushed it down from the top, but they kept on going and they held it. So this is an additionally bearish version of the inverted hammer. If you see a green inverted hammer up at the top of a move, then it's also bearish, but not quite as bearish, because the sellers were only able to get the price down to about here. They weren't able to actually get price lower than where it opened, but they're still very powerful, and you need to wait for the next candle to confirm, is a reversal actually taking place or not? Now let's talk about dojis. Now, a doji is a special kind of candlestick that is usually kind of small in size. So usually the high to the low doesn't have a really large range. But the key characteristic of a doji is this. It's that the open and close are almost exactly at the same spot. Very, very, very small body. All right. Sometimes they're not exactly the same spot. It's just a tiny little thin red candle or a green candle. But the main point is that the legs or the wicks of the candle are poking above and below, and then you've just got a really thin body. And it can have a bunch of different shapes and forms, and it doesn't have to always be in the middle like this. You can have what's called a dragonfly doji, where it's up at the top, and you can have what's called a gravestone doji, which sounds really scary and ominous, where the body is at the bottom, etc. And you can have a doji with almost no range whatsoever, or you can have a doji with a very large range. But the key characteristic is this very, very small body. Now, what this tells you is going on is indecision in the market, right? It's who's winning. Bulls, bears, bulls, bears, bulls, bears. And at the end of the period, nobody wins. It's just flat. It's a tie, all right? It's a stalemate. So the market can't figure out what it's going to do. Which way are we going? Are we going up? Are we going down? We don't know. So you need that next candle, again, to confirm the direction. And if you see these in the middle of a trend, just in the middle of nowhere, which you will see quite often, they're not really all that significant. You're looking for these to happen at key price levels where you're anticipating a reversal might happen anyway. When you see this, it means the market got up to that level, and let's say that it's the buyers pushing it up. Let's say it's an uptrend. The buyers were pushing the price up to that level, and then they weren't really sure if they wanted to keep buying or not. And they have indecision, and that's what we're seeing here, is that indecision being reflected in the shape of the candle. Now, these dojis are particularly important if you see them with very high volume. We're going to talk about volume in a little bit. But when you see high volume and a doji, it just means that there is a major fight going on, and there's a lot of participation in this fight between the bulls and the bears. And whoever is going to win is probably going to win with some power behind them. So you want to be prepared for the next candle to get on board with whichever direction wins the fight. So all of these candles that I'm talking about, these are really only significant to us, and they are by far most effective when they happen at significant price levels, okay, or key levels. And these levels are generally going to be buy or sell zones, which we're going to show you how to identify and how to draw, or what we call significant swing points, or sometimes they're referred to as pivot points, which we're also going to talk about, or just general support and resistance areas. Now, when you wait for a candlestick pattern, an engulfing or a hammer or any of these things to happen at one of these key levels, it's going to give you the highest probability trade. Now, as an example to illustrate that, take a look at this down move here, right? We have this down, 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 price coming down, 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 down into this level. And then we have a doji at that level. This is a buy zone. There's a line here that I've drawn to indicate a buy zone was waiting down there. And you have a doji that happens right at that buy zone. And then you have a second one. And then you have a third one with a slightly larger body, but still showing indecision. And you have just a lot of hesitation at this level. Price just does not want to go any lower. As soon as you see some kind of sign that price is turning around and leaving the zone, once you see something like this, some green candles starting to leave the zone, you know the train is leaving the station. You know which direction to go. It's time to jump on board. Now, I also want to point out one other thing. Take a look at this. Notice this doji right here, right? In the middle of the trend. There's another one right here in the middle of the trend. There's another one right here, okay? These happen all over the place. They happen all the time in the middle of trends. There's another one, a green one right there, right? But they're not at a significant level. The significant level was down here. This is the buy zone where I've drawn this line. So you just ignore any candlestick noise that happens until you're at a key level. Only pay attention to these at these key levels that we're going to show you how to identify. Now, these candlestick patterns will happen on all different time frames. You'll see these on 5-minute time frames. You'll see these on daily time frames. You'll see them on monthly time frames. They happen on any time frame. And when you notice them on your smaller time frames happening at important levels, it can give you a really useful early warning, a heads up that it's time to take your profits and maybe step aside because the market is maybe going to turn around, or to prepare to get into a trade if you're not already in one. Now here's an example of the same thing in an uptrend. So we have a sell zone up here, which is what the yellow line indicates. There was a sell zone key area here. Price got up to it once, rejected, got up to it a second time with a doji right there. And then the next candle was red, so it confirmed reversal. And not only was it red with a big long wick indicating a failure of the buyers to keep the price up. They couldn't do it. Sellers came in and sellers won the day. And that means that the trend is likely to reverse. And sure enough, there it went. Down we go. So make sure you pay attention to these, but only at key, significant, important levels. When you see a doji, this one here is sort of a slightly large body doji, or like there's one right there, this green one right there. When you see these at just the middle of kind of nowhere, no significant level or anything, pay them no attention. Just ignore them. They only really matter to you at a key important price level. Now the candlestick size itself also has meaning. These candlesticks are a great way to see momentum, okay? Because if you see a large range candlestick, well, that shows you that whether it's green or red, whoever it is, buyers or sellers, but somebody is firmly in charge. When you see a very large candlestick, it suggests a lot of momentum, especially if you see this on high volume. Now, this down here is volume. I'm going to show you that full screen here. This is what volume looks like by default in most trading platforms. It might be a little different in some, but generally speaking, it's going to be this, what's called a histogram here at the bottom of the screen, these little bars here. And these bars represent volume. You can see the scale on the right-hand side. So typical volume here was, bouncing around 4 million or so shares a day. This is a daily chart of Amazon. But then all of a sudden here, where there was a doji, we had over 13 million shares that day. Way, way above the average, right? And it was after price had come down, flashed a doji, huge volume, and then the next candle was up, suggests a reversal, and then price bounced from there. So that's the kind of thing you want to really watch for, is volume confirming your candle pattern at a key or significant price level. Now in trading, there's generally always a lot of talk about indicators, right? Traders tend to love their indicators. But the word indicator is really just a generic term for anything that you can add to your chart that just draws automatically without you having to do anything. All right, they're also called studies in a lot of platforms. Now these are different from drawings. All right, drawings are something that you manually draw on the chart. That could be lines, circles, text, squares, triangles, whatever kinds of drawings you want to make on the chart. Those are completely manual and you have to do them. But indicators draw stuff completely automatically without you having to do anything. You just apply the indicator to your chart and then there it is. Now there are hundreds, probably more like thousands of indicators out there. It is really, really easy to get completely overwhelmed and just lost in the possibilities and the potential, especially for newer traders. They always look like these are the secret holy grail and these indicators tell you exactly what's going to happen and they predict the future, but they don't. And all of these indicators are using the same data. Generally speaking, that's usually the open, the high, the low, the close, and volume. That's it. Those 5 data points. That's all they're all using, and they're all using the same data. So really watch out for what's called analysis paralysis, right? Just having so many indicators on your chart that you don't know what to pay attention to, and it's really, really easy to get yourself just totally lost and confused and end up with conflicting indicators telling you different things, and you don't know what to do. Some of the more popular indicators are things like moving averages. There's an indicator called MACD, which stands for Moving Average Convergence Divergence. And there's another one called RSI, which stands for Relative Strength Index. Those are very popular. And we do actually use some of these indicators in very specific ways. We're going to talk about exactly how we use those a little later. So here's an example just showing you what a chart might look like with a couple of moving averages up above on price, the yellow and the white lines. Those are moving price averages. And then we've got the MACD indicator right below that with the blue colored histogram and the pink and yellow lines crisscrossing all over the place. And then right below that is RSI with the line that goes red once it crosses that green to the top, or it goes blue once it crosses the green to the bottom. And then we have just volume at the bottom of the chart, but with a moving average as well, so you can see when the volume gets above or below the average volume. Now, markets are really nothing more than crowds, right? This is people, and a chart is showing you what the people are doing in this market. And people tend to remember where they bought or sold in the past. Well, when you combine memory and emotion, you end up with predictable patterns of behavior that human beings are going to tend to repeat over and over. Even the algorithms out there that are trying to automatically trade the markets, even those algorithms are made by humans. And so they are initially, anyway, set up to work on human rules and human understanding. The repetition that human beings will tend to exhibit over and over again show up in the charts, and it forms patterns. When we learn to recognize those patterns, we can exploit them for our own profits. Now, the number one thing to keep in mind, though, is supply and demand. These are the only two factors that move price. They are the most important factors of anything in trading, supply and demand. And they are what forms our buy zones and our sell zones. Okay, a sell zone is just simply an area of price where in the past, selling has overwhelmed the buyers, and that drives prices lower. And a buy zone is just the opposite. It's just an area of price where the buying in the past overwhelmed the sellers, and that drove prices higher. Now, when prices are falling, it scares the crowd, the market, right? It scares the participants. Everybody freaks out and panics, and that encourages selling. And so you see more selling behavior when prices are falling. And a rising price excites the crowd. They get all fired up and enthusiastic and, oh, buy, buy, buy. It's going to go up. It's going to go up. And that's what encourages buying. You saw this in that cartoon at the beginning of the section. But markets never move in a straight line. Make sure you remember that. They do not move in a straight line. They always have to move in trend patterns of higher highs and higher lows, or lower highs and lower lows. Now here is a humorous but fairly accurate, actually, example of what tends to happen to most retail participants in the market, especially newer traders, newer investors who don't really know what they're doing yet. So here we have an example of a stock, a whatever it is. Doesn't matter what it is, but it's a new hot thing. You get a tip from your friend at work or your cab driver or whoever it is. Somebody gives you a tip on this stock that you want to buy, and so you're all over it. You jump on board and you buy it, okay? And that's called going long. So you know you are now long this stock. And then it promptly turns around, right? And it hits a price level where you want to get out. And that is what's referred to as a stop, okay? It's literally to stop the pain of loss, okay? And so if it hits your stop, when a stock or anything you're trading hits your stop, it's referred to as being stopped out because it hit your stop and now you are out of the trade. So that's what happens here. You bought at the first point A, and then price promptly turned around, reversed, went down, and then hit your stop and took you out. And then price continues to go a little lower. And so you think, aha, I know how to short. And shorting is simply the process of selling first and then buying back at a lower price later. Okay, so even though you don't own it yet, you can sell it. You just have to buy it back later. So you decide to go short. You're going to make your money back to the downside because clearly you were wrong about this stock going up. It's now headed down, so you're going to make your money back. You go short at this level at point B, and then, of course, again, price promptly turns back around and again hits the level where you just can't take the loss anymore and you have to get out. And so you do. Hits your stop and you are stopped out. Well, that is very frustrating. Then price actually goes even a little higher than it was before. So now you're thinking, aha, I was just early last time. This is the breakout I was waiting for. Now I'm going to nail it. I'm going long again. So you jump into the long side once more. And once more, it turns right around and takes out your trade. Well, what the hell's going on here? This is incredibly, incredibly frustrating when this happens, right? Well, last time around, you went short at this level and you lost. So you're not willing to do that again. But you don't really have the confidence to go long here either, so you're just going to wait and see what happens and let it play out. And sure enough, price goes back even higher than the last 2 times it was up here. So you know what's going to happen this time. It's going to head down. So I'm going to short it. And now I'm going to make all my money back. I'm going to have all my losses covered. Here we go. We're going short with a perfect top. We're nailing it right at the high. And then it promptly goes even higher, takes out your stop, and then proceeds to break out to new highs. Well, how is this even possible? Right? Why does this happen? If I were to have flipped a coin on whether I buy or sell at each one of these points, I should reasonably have better results than this. I shouldn't lose every single time. So why does this keep happening? Well, the reason it keeps happening is because there are these zones on your charts called buy zones and sell zones. They were already there. They had been there for perhaps weeks, maybe months, maybe even years in certain markets. And these are levels where in the past the institutions have shown that they want to be a buyer and they want to be a seller. Because the supply and demand that we're talking about when we talk about supply and demand being so important is not retail supply and demand. It's not you and me. It's not the small retail traders. We are way too small to move these stocks like Amazon, Apple, Netflix, etc., these big companies. We don't buy enough. We don't buy 100 million share orders and things like that. So it's the institutions who are doing the buying and the selling. And we just want to piggyback on what they are doing. And these are the levels where in the past they have shown they want to be a buyer or they want to be a seller. But every zone eventually breaks, just like it did here. The trick is you have to know when is the zone likely to break and what signs do you look for to indicate that it is breaking. Now, markets can only be in 2 possible states at any given time. They can either be in a balanced state or they can be in an imbalanced state. Now, they cannot be both simultaneously. Balanced markets are horizontal, right? Sideways markets, range-bound markets, channeling markets, etc. During these periods of time when the market is going horizontal, you can scalp small trades, small profits. Just grab a little here, grab a little there. Nothing big, nothing major. You're just going to grab little profits, grab whatever the market will give you. But during an imbalanced market, the market is vertical. That's when you get big moves. That's when you can catch your major trend moves, right? Your major swings, and that's where you can make your big money. But the thing is, the markets are balanced about 70% of the time. Markets are going sideways 70% of the time. We just mostly hear about and get excited about the big vertical swings. But most of the time, they're not really going anywhere. So if you don't learn how to trade in any type of market environment, you're stuck only really being able to trade profitably 30% of the time, because you can only trade when the market is making big moves. The rest of the time, you're just going to get chopped up. So you need to know what you're doing and learn how to trade properly. Now, here is an example of a balanced market, and it's pretty clear. It's moving sideways, right? It's bouncing around back and forth between this low and this high. This is Tesla, and Tesla was trapped in this range for quite some time. It's actually still in that range right now as of this recording. And it just keeps bouncing back and forth between these levels. Now here is an imbalanced market. This is a chart of natural gas. And you can see it made some big swings. It was, kind of moving sideways in a little channeling range, and then all of a sudden, boom, big move down, and then turned right around, boom, big move up again. And then another big move down after that. So that is what a market looks like when it gets imbalanced. You get these big, sudden vertical moves up and down. Now, it's extremely important that you really get comfortable with understanding trends. And we already defined a trend previously, but let me do it again just to reiterate. An uptrend is a series of at least 2 higher highs and higher lows, and a downtrend is a series of at least 2 lower highs and lower lows. But then there's also a sideways trend, which is just simply a series of highs and lows of roughly the same height, like that Tesla example I just showed. Now, a new trend will very, very often form after there's been a big vertical move up or down. And all of these time frames will share all the different trend types at the same time. So if your daily chart is in a strong uptrend, you might go look at your weekly chart and see that it's actually going sideways in a range. And you might look at your 60-minute chart, and right now it might be in a downtrend. And your 15-minute chart might be in an uptrend, and your 5-minute chart might be going sideways. And so all the different time frames are going to show all different trends all at the same time. And so you need to get comfortable with understanding how the different time frames interact with each other and what that means. So here's a better picture, a little more detailed picture of an uptrend. Okay, again, we have our series of at least 2 higher highs and higher lows. But here's a really important component. When does a trend end? All right, how do you know the trend is done? Well, price came down, 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 made lower lows, lower high, lower low, lower high, then made its first higher low, right? Then we have a higher high, higher low, higher high, higher low, higher high, higher low. Then we have a failure to make a higher high. Okay, and we have our first lower high. But that by itself is not the trend being finished yet. The trend is not done yet just because that happened. We need to see this happen. It has to break the previous higher low. Once you see that, then you know this bullish trend is done. The trend is finished. Now in a downtrend, it's the same basic idea. You have an uptrend making higher highs and higher lows, higher high, higher low, higher high, higher low. Then we have a failure to make a higher high, a lower high. Once it breaks the previous higher low, then we have lower low, lower high, lower low, lower high, lower low, lower high, first higher low. And then, again, that is not by itself the signal. The signal is it breaking the previous lower high. Once that happens, then the trend is officially done. Now, a sideways trend, pretty clearly, is just bouncing around in a range. Now, within that sideways trend, you can see on a smaller scale, there's higher highs and higher lows and lower highs. So all of these things we're talking about will always appear inside each other's time frames. But generally speaking, anyway, on a larger picture, if you see a market bouncing back and forth between a particular set of prices and never really getting above or below them, and not continuing to make higher highs and higher lows or lower lows and lower highs, well then that is a sideways or balanced or trading range or range-bound market. So here we have an illustration of trading an uptrend. Now price on the left-hand side came down, 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 was making lower lows and lower highs until it stopped going any lower where the circled point is, and then you can see it started making higher highs and higher lows. But until it broke above the previous lower high, which is where the dotted line is, there was no confirmed trend change yet. The price could have kept going down. But once price broke above that high, then it pulled back again to test to form a higher low. And then at that point, the uptrend was established. And then you always hear the old saying, buy the dip, right? Well, here it is, buy the dip, buy the dip, buy the dip. In an uptrend, every time price pulls back, as long as it's still making higher highs and higher lows, you buy that dip. And you just keep doing that until the trend shows you that it's run out of steam. Now on a downtrend, the opposite scenario is playing out. On the left-hand side, we have price going up, 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 until it stops making higher highs, makes a lower high, and then breaks the previous higher low at the dotted line. Once that happened, everybody sees it, everybody recognizes, oh, the trend has changed. Now, instead of buy the dip, it's sell the tip. Every time there's a rally, you sell the tip of that rally. Sell, 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 every single time until the trend turns around, starts establishing higher highs and higher lows, and breaks the previous lower high. Once you see that, you know that the downtrend is over. It's time to take your profits, step aside, and wait for something new. Now, I want to point out one thing. In the middle here, there is a higher high. Okay, so you might think that, oh, well, it was a downtrend. It was making lower lows and lower highs, but then all of a sudden it made a higher high. So wait a minute, that doesn't fit. Well, yes, it does, because it did make a higher high, but it then made a lower low. So the trend was still intact. If it had made a higher high and a higher low, and had done at least 2 of those, then we would definitively say that the trend reversed at that point. But it did not. It made 1 higher high, 1 higher low, a second higher high, and then a lower low. So it failed to actually establish that the trend was changing, and instead it confirmed actually that the trend was intact. Now here is a sideways trend, right? It's kind of going nowhere, just bouncing back and forth in a very small range. It's bouncing back and forth in a 20-cent range in this case. And it's quite typical in a sideways trend like this to see the wicks of the candles kind of poke above and poke below. That's fine, but generally you can still tell that this is just bouncing around in this general range. There's no clear trend. It's just moving sideways. Now let's jump back over to live charts and take a look at this in the real world. So, welcome to TradeStation. For the rest of this course, I'm actually going to be doing the bulk of my demonstrations using TradeStation, since it's actually the platform that I use and I trade with every single day. So you'll see a lot more of this going forward, and I wanted to just start introducing it to you and get you familiar with kind of how it looks. So first of all, this is a price chart. And like I described, we have time along the bottom. In this case, this is a daily chart. You can see it in the upper left-hand corner. This is a daily chart of Qualcomm. You can see it in a couple of places here. You also can see it faintly in the background there. It says QCOM. It's watermarked in the background. And we have price along the right-hand side. Now, down here, we have volume, because this whole section, everything down here, is the volume histogram. And in this particular case, I have an average on the volume as well, which is the yellow line here. So the yellow line is a constant running average of the last 50 days worth of price, since I'm looking at a daily chart. If this was an hourly chart, then that would be the last 50 hours average of volume. So it makes it really easy to see where volume has spiked or dipped, right? It's clearly the case that here is a little bit low. Volume dipped there at that moment. And this is high, higher than average. This is higher than average. And of course, this is ridiculous. This just happened the other day, and Qualcomm settled some sort of dispute with Apple, and everything just went completely ballistic. And you can see everybody wanted to pile in to buy this up. So that is to say that's unusual would be the understatement of the century. So now, in a price chart like this, a daily chart, we have candles, right? All of these are all candles, okay? And we have up candles in green and down candles in red. And you might recall that the only difference is where they open and close. On any candle, you have the high of that period, in this case, a daily period. And then down here, you have the low of the period. And then, because this is a down candle, it opened right up here, and it closed right up there. So we know instantly that this is a down candle, because it closed below it opened, and it's red. That's the default. Now, in the case of a green candle, like let's just use this giant monster here as an example, because it's really easy to see what happened. The highest it got was right here. The lowest it got was right there. You can just barely make out a little tiny bit of wick there. And then but first, actually, so let me back up. At first, it opened here, just above the wick, right? It really didn't go much lower than where it opened. It did for just a split second, and then it shot up. And the close of the day was up here. So it closed very, very close to its high. And now that actually brings up something that we haven't really discussed yet, and we will probably talk about more later, but I'm just going to point it out now since this chart is a perfect illustration of that. See this big empty space right here? This is a gap. This is a price gap. So the price closed here, and the next morning it opened here. So it jumped, and it never really came back down. And that's not surprising, because what this gigantic candle here is telling us is that there was massive, massive momentum to the upside. And when you have that much momentum going upwards, the odds are that it's probably going to want to continue. It's, just got a huge amount of pressure there. And so the next morning, it just, shot up to way up here because there was so much buying pressure. That people just had to have it at any price, and so they ended up paying this price up here, which clearly a lot of people were happy to sell at because there's a big wick here. So this whole candle, in fact, is a doji, right? Little itty-bitty tiny body and big wick on either side. So this is, I guess you could even call this a long-legged doji if you wanted to get really specific. We don't usually bother with those kinds of terms. We just call it a doji. But the point is that it shows indecision. So the buyers and the sellers were pretty evenly matched here. Here, the buyers completely overwhelmed the sellers, very, very clearly. Right? That's why price went up so much, is because the buyers were just demanding this no matter what the price was. They just had to have it. But here, not so much. Here, it's very evenly matched. We ended up closing right where we started, pretty much right in the middle of the range, and there's a battle going on. And then the next day, which was today, not much happened. Fairly small range. So right now what we're seeing is there was a massive amount of demand, and now it's going kind of nowhere. And so this tells us something about the psychological state of the participants in the market right now. They're undecided. Is Qualcomm going to continue to rocket upwards? I don't know, maybe. But right now anyway, everybody's just kind of taking a breather, trying to decide, okay, well, what do we want to do? If I bought somewhere, down here or somewhere back here or something like that, do I want to sell and take this windfall profit I was just handed? Or if I bought here, am I looking at this and saying, oh, it better hold? I'm looking for, Qualcomm should hit 100 soon or something like that. People have unrealistic expectations a lot of the time when they buy into something that is overly excited, like this clearly was. So now I want to point out a couple other things about this chart. First, we have down here a buy zone, right? And this buy zone, let me collapse this. This buy zone was created, just actually move this completely out of the way, was created from this section back here, this area back here. And let me actually zoom out just a little bit so you can see it better. Okay, there we go. So yes, sorry, I was looking at the wrong thing. Yes, so this buy zone was created right there, and it extends to the right, okay, into the future. The next time price gets back into the zone, we have a high probability potential trade. We're going to talk a lot more about this later, but there are a number of factors that make this look like an attractive buying point. The first is we're back in the buy zone. Okay, so that's point number one. Point number two is look what the volume was doing. Volume jumped up above average. So during this little pullback, right, we have an increase in volume. That says that people are buying this dip. So yes, it's a dip in price, but that's fine, because where did it dip to? It dipped right to our buy zone, and it did so with above average volume. So that's another check mark in the plus column, if you will, that there might be a potentially good entry here. And then lastly, we have this green candle here that leaves the zone. Price then comes back and tests the zone right there, just comes back and touches it and then leaves again. That's all the confirmation you would need to take a long entry. If you weren't willing to get in somewhere right down here towards the bottom of the zone, just based on the touch of the zone alone, and that would be perfectly reasonable if you didn't want to get in because you don't have any confirmation yet, then certainly when you see that, you see price leave the zone, retest it, and leave again, there's no question. That is a trade you want to get on board with, and you can have a fairly small amount of risk because your exit point, if you were wrong, could just be right outside the zone. So the worst case, you've got a loss here of, what is that, about $2? So you've got about a $2 a share loss, but your potential gain is, if all it did was get up to a recent area, a recent high area, and I'm looking at this gap here, and if all it got to was there, you're talking about $60 a share. So you buy at 50, let's call it 51 even, and you get out at 60. Hey, that's a $9 a share gain for a $2 per share risk. That's a great risk to reward. Now, in reality, of course, Qualcomm went completely bananas and went straight up. And so you might have even hung in there and caught some of that, but you can't count on that kind of thing. That is certainly not a standard type of thing that just happens all the time. Now let's take a look at another chart. And in this one, we're talking about, again, a daily chart. This time it's NVIDIA. See it right there, NVIDIA. And much like the previous one, we have a buy zone, okay? And the buy zone was formed by this area here. And don't worry if you don't understand exactly how we drew these lines. We're going to get into the specifics and detail of exactly how to draw buy and sell zones very soon. But for right now, just don't worry about the detail and just accept that this is a buy zone. And the next time it got back to the buy zone was right here. And it came back to the zone, kissed it, and then left. That is a good confirmation because you also have huge volume. So people bought this dip in a big way. I mean, massive amount of shares exchanged hands. I mean, 55 million plus, more like 60, probably about closer to 60 million shares traded, whereas the average down here was like 20 million. So it was like 3 times the daily average amount of volume traded in just that one day. That is enormous. So that was, again, a great long entry. Again, you have low risk because you can put your stop right outside this level. So if you're wrong and price just collapses, okay, you're out with a small risk. Now, in this case, NVIDIA is a higher priced stock. So you're talking about if you got in at, say, 134, maybe just above this zone as it was leaving the zone, you'd have to have risk down around, 124 or so. So, $10 a share in risk. But what's your potential gain? I mean, certainly NVIDIA was up here at almost 300 not that long ago. So it could recoup if all you did was look at, again, this is almost exactly the same as the what we were just looking at a second ago with Qualcomm. If you just looked at this gap area here and this high here and said, I think it could get somewhere in this area. That just seems like a comfortable target. Then you're talking about, call it 180 a share. So you buy at 134, you sell at 180. Again, that's a fantastic risk reward. That is, we aim for at least a 2-to-1 reward to risk ratio, and that's considerably better than that if your risk is $10 a share. So this is the kind of stuff you look for, but it's very important to point out, you need multiple coinciding factors. You never want to take a trade just based on one thing. Okay, you would never take a trade based on just this. Just a volume spike at a random place. Okay, that is not a good idea. That is not reason enough to take a trade. But when you see a huge volume spike and price coming back into a buy zone, and you see it leaving the buy zone, that it could be enough. That is multiple factors. And there are actually even other things that we're going to be showing you a little later that can give you even more confidence and more confirmation that a trade is a good idea to take, and potentially even let you get in earlier. So you could get in more at the bottom of this area instead of actually waiting for it to leave the zone and maybe getting in there or something like that. Not that that would have been bad. I mean, that would have been perfectly fine. But hey, lower is always better, right? Now let's take a look at, this is Disney. And this is, again, a daily chart of Disney. And in this case, I want to introduce something that, don't worry if it looks confusing and complicated and crazy. We're going to talk a lot more about this in later chapters when we get to Fibonacci retracements and extensions. But I just want to introduce it here and point out something to you. So here we have an area where price, Disney was going up and up and up and up and up, and it pulled back and it established a low. Okay, this is a higher low right there. And then it embarked on its next move upwards. And it got to this point here. And this point here, then it pulled back. It retreated. So the question would be, when you see something like this and you see it retreat and it breaks the previous higher low, which it did basically right about there, you can do something called a Fibonacci retracement, which is what this line here is. And that draws all these numbers, okay? And the numbers that we care about the most are these three. Again, I will get into the details of these numbers and what they mean, their significance, and everything later. Don't worry about that for right now. I just want to show you that there is a 70% probability that price on a pullback will get to somewhere between these three numbers, 38.2, 50%, and 61.8. And so this allows you to roughly measure where the dip should end. Because everybody always talks about buy the dip. Buy the dip, buy the dip. In an uptrend, you buy the dip. Of course, we also say that in a downtrend, you sell the tip. But buy the dip sounds great until you ask yourself, well, where is that? How do I know when the dip is done dipping? Well, Fibonacci retracements allow you to project where the dip should probably finish dipping. And when you see that happen, you see a level in here get reached, and then price starts to turn around and leave, especially when you see it happening on high volume. So again, we have people buying this dip heavily. This is major buying going on in that dip, because look how much higher than the average that volume is. I mean, this day here, we're talking 45 million shares, where the average is, 10, 11 million. Massive buying this dip. So when you see that dip stall out at somewhere in this area, you know you've got a high probability that the dip is done and you want to buy that dip. And of course, price did go up. It leaped over the previous highs, huge gap to the upside, and has kept on running. Now, again, as I mentioned before, you can't count on something like that. These big, sudden, huge moves like that, you don't know that they're going to happen. But if you can position yourself properly and you can buy at the right locations, then you're in the right position to take advantage of this kind of thing when it happens. All right, let's take a look at one more chart here. And this time it is a chart of crude oil. But I specifically want to point out this is a little different. This time it's a 10-minute chart instead of a daily chart. This is a futures contract, and the symbol is CL, which is the symbol for crude oil. It doesn't really matter that it's a future or a stock or anything. It's irrelevant. It's the analysis doesn't change. It's all the same. So on a 10-minute basis, though, okay, so this analysis, everything we're talking about works exactly the same on smaller time frames. So here we have a case where there was a buy zone established here. Price came down, 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 and then stopped falling. Bounced, established a zone, came back, kissed it once here on, some volume. It's a little bigger than usual, but kissed that zone and then bounced and then pulled back into it fairly hard. But this time, look what the volume did. Enormous, huge volume coming down into that zone. And then sure enough, there's a big long wick. Buyers bought it right back up again, rejected the zone, and it started to move higher from there. And in no time at all, just a matter of hours, we're talking about a move like this. And in crude oil, if you were to trade the smallest amount that you can, which is one contract, each 1 point of movement, and here's the scale here, right? So 63.20, 63.40, 63.60, 63.80, 64, okay? And 64.20. So from here to here is 1 point. Now, 1 point is worth $1,000 in oil futures. So that means if you bought somewhere in here as it was leaving this zone, say you bought at 63.30 and you got out at, let's say you just got out right there because you felt like, I think it's probably running out of steam or whatever you thought. If you got out there, that's 1 point. That's a 1 point move in, what is that? Let's see, from like 7 o'clock a.m. to, 9 o'clock, 8 o'clock p.m. So, 10 to 12 hours, you're talking about $1,000. $1,000 gain. Just a straight shot. So this is the power of futures and the leverage that they provide, because you would only need to have, a couple $1,000 in your account to be able to do this trade. So you could potentially get as much as a 50% return on your investment in 10 hours or so. So the key, though, is that a buy zone was established, price came back into the zone, and then left the zone on huge volume. That combined together gives us a reasonable low-risk trade because we can put our stop just outside the low of this wick. So if we're completely wrong and price just collapses, we have a small loss. And then if price does not collapse, if this rejection of the zone holds, which it most likely will, then we have a huge upside. So small risk, definitely much larger reward, which is what we want to look for. We always want to look for a good risk to reward scenario. Now, let's also look at some other chart timeframes, okay, just to illustrate the different ways you can look at charts. I'm going to go back to our Qualcomm chart. And again, this is a daily chart, so every single one of these candles represents one full day of trading activity. Now, however, I can go into a smaller time frame. So I'm going to select, let me move this out of the way. I'm going to select a smaller time frame. I'm going to maybe go down to actually, no, I'm going to go up first. I'm going to go up to a monthly chart. So now we have a monthly history of Qualcomm going all the way back to about 1999. So we can see Qualcomm's history going way back even to the dot-com bubble. Right? We can very clearly see the bubble popping right there. Okay, this is a monthly chart. So that means this huge red candle right there, it took a full month for that to happen. It took a full month for this big green candle to push it upwards. So that was a full month of activity. Now notice this here. This big green candle here, that was pretty much one day. That was just the other day, that massive move up. Most of that was going to be from just the one day. But now we can see historically what has Qualcomm done. And when we look at it on this time scale, and we're looking far enough back, there's a very important thing we need to keep in mind to do. And this is something we're going to talk a lot more about later in the course, but we're going to tell you to look left. So I'm going to give you your first sneak preview of looking left here, and especially on larger time frames. By going to a larger time frame, I notice this. In the past, the level where we are right now, actually we're right there technically, is pretty much right there at a previous high. This is a sell zone. In fact, I'm going to go ahead and, I'm going to go ahead and plot it. Second line, and right there. This is a sell zone. That means at this level, we are not looking to be a buyer. We are looking to be a seller, or take profits, or do nothing. Nothing is always an option. But the main point here is price went right up to the sell zone and then retreated, and it left a wick. And right now it's going sideways. So the probability is price will probably reject, because this is the first time it's gotten back to this zone. It hasn't even been up anywhere near here since all the way back during the dot-com bubble. And we can see that didn't last for long. So right now anyway, Qualcomm is in a relatively dangerous area. You'd have to be really cautious about buying here. I would not want to be a buyer of Qualcomm at this level, but I don't know that unless I look at a bigger time frame and look to the left. Now let's go down to a weekly chart and see what we see on a weekly. Okay, on the weekly I can see it even more clearly. There's the zone. It got up into it, went sideways for a while, and then couldn't hold it, and then down and down and down, lower lows, lower highs, lower lows, and lower highs until it bottomed out and turned around and started making higher highs and higher lows. So you can see, I mean, really, look at that. I mean, it kissed it exactly. It went right to that zone. The zone is at 82.58 is the top of the zone. What was the high? The high, 82.52, 6 cents away from the top of the zone. That's how precise these zones can be when they are re-entered. So right now, this is Qualcomm's range on a weekly basis. But again, on a daily chart, I'm probably not going to see that. If I zoom out on a daily chart, oh, it's just barely there on the left of my chart. And that's actually because I have my charts set to show quite a bit more data. This is not the default. The default settings would probably not show me that at all. I would probably see something like this. And I have no idea. I wouldn't see this zone. I wouldn't even know it's there. So it's critical that you always get in the habit of looking at larger time frames and then looking left. Even if you're a short-term trader, even if I'm a day trader and I plan to be in and out in minutes or hours, I still want to know what's to the left of me, because something like this is telling me I'm going to get ready for a big short opportunity, because most likely price is not going to hold up here and it's probably going to reject and come down. And I want to be ready for that. I want to position myself to take advantage of that when it happens. Now let's go down into some much smaller time frames. I'm going to go down to a 60-minute chart. So now on a 60-minute basis, data is still loading. There it is. We have, you zoom in so you can see it. Each one of these candles now represents an hour's worth of time. I'm going to get rid of that big green candle on the right so that the scale adjusts. So each one of these candles is 1 hour of time. And you can see that if I click and hold in TradeStation, I can go hour by hour, and you can see the numbers changing there as I move to the right. There's next morning, next day, 7:30 a.m., 9:30, 10:30, 12:30, etc. Next morning, and so on. So we have a 1 hour of data. And this also can tell me other things. Again, if I'm a day trader, this might be really important for me to look at and consider, because this might be long term to me. If I'm used to trading on a 1 minute or a 5 minute chart, a 60-minute chart is kind of long term. That's a long time for a day trader who's in and out in moments. So you really need to understand all these different time frames, and over time, you will come to recognize the way they interrelate to each other. The smaller time frames are always contained inside the larger time frames, and we're going to end up talking a lot more about that a little later as well. Now let's go all the way down to a 1 minute chart, which technically is not even the smallest you can go, but for right now, let's just look at a 1 minute chart. Now this is a very fast chart. Every single one of these candles here represents 1 minute of time. If I click and hold here, you can see that's 11:39 a.m., 11:40 a.m., 11:41 a.m., 42, etc. So this goes by very quickly. Every minute you get a new candle, a new candle, a new candle, a new candle. And this is why day trading is very possible. Because, for example, if I see that there was a zone here where price pulled back, stopped, marched higher, got back to that zone again, right? Got right in there again, there might be a buying opportunity there. If I see a combination of other factors happening, for example, look at the volume on this pullback. People were buying this dip. So maybe I look at that re-entry into the zone as a buying opportunity, and sure enough, boom. In 5 minutes time, I could go from, say, 79, let's just call it 79.60 to 79.90, 30 cents a share in 5 minutes time. Now, that doesn't sound like much, but for people with large enough accounts that are buying, 10 or 20,000 shares, that adds up, especially in 5 minutes time. You get good at spotting these kinds of things. They happen all the time, every day, over and over and over again. Now, let me also briefly introduce indicators to you. I'm not going to go deep into them. We're going to talk much more about them later and really get into the specifics and details of what they are, how they work, how to set them up and everything. But right now, I'm just going to show you adding some indicators just so you see what they kind of look like. So I'm going to right-click on TradeStation in the background of the chart. In Thinkorswim, it's a little bit different, but we'll talk about that later. And I'm going to select Add Study. When I do that, I get this dialog box here that has indicator on the left-hand side. That's what I want. I want the indicators. These are all other things that you can also add, but right now we just want indicators. And I have a whole host of options. I mean, there are hundreds of them. You can see here, massive number of possible indicators. But let's not get crazy. Let's just pick something simple, like let's pick a moving average, okay? Moving average, I'm going to choose moving average exponential, okay? So I'm just going to go ahead and add that to my chart. Hit OK. There we go. I have a moving average. And it doesn't matter what the settings are on it right now. We're not getting into the details. It's a moving average, okay? So I have this nice average of price. I can always see where the average is at any given time, an average for a certain period of time. Now let's add another indicator. Another one that we use a lot is the MACD. Let me add MACD. There it is, MACD. I'll add that. And it appears down here on the bottom of the chart. Whoops, it looks like one of my default settings is wrong, so let me just fix that. There we go. Okay, so now I have the MACD, and the MACD consists of a couple different things. It's got a histogram in the background, which is the red and the green bars, but then it also has these two lines in front, which at first glance look a lot like the moving average that's up here. But they're actually different. In the case of MACD, these are called the MACD line and the signal line. We'll get into those more later when we actually cover MACD. But just know that this is kind of what it looks like. And it tells us some really useful things when we combine it with what we know about what's happening on the price chart. Now, I'm going to add one more, which is called Awesome Oscillator. This is another one that we use quite a bit. It's kind of a funny name, but I'll add the Awesome Oscillator. And it looks like this down here. And at first glance, you might think, oh, it's the same as MACD, but it's actually not the same. Yes, they both use a histogram, so of course it looks similar in that it has bars above and below. But it doesn't have the lines, and you'll notice that the histogram bars, don't line up exactly the same. So they actually are different, and we use them in different ways. We actually use them together in a combined way. We're going to talk about how to set that up later. But just, to see what these look like. So here we have a chart with volume with an average on it. We've got our MACD. We've got our Awesome Oscillator. We've got a moving average on our price chart. And this is on a 1 minute chart. So notice that these indicators are showing me all this information about what's happening at a 1 minute time scale. Now watch what happens if I change to, let's go back to a daily chart. All my indicators are still there. And they're still showing the same type of information, but now it's based on daily periods of time. So indicators are automatic. You don't have to do anything to manipulate them to fit a particular time frame or anything like that. You just turn them on and they show you whatever you set them to show you. And they have a lot of different settings. We're going to talk about the settings that we use, how to actually set them up, why we set them that way, and so forth. But just so you have a familiarity in passing with what these look like, what they're called, again, this is MACD here, and awesome oscillator down here, and volume here. And then this is just a basic moving average. It's an exponential moving average of price. And these, of course, are just horizontal lines that I just placed to illustrate my buy zone and my sell zone. Now that you've completed up to this point, it's time to take a quiz. Now, don't worry, this isn't meant to be really difficult or to stress you out or anything. You're not going to be graded, and you won't be prevented from continuing in the program if you don't pass a certain score or anything like that. It's nothing like that. This is just another way for you to reinforce the materials. In fact, I'm actually going to give you both the quiz and the answer key so that you can check your own work. So this is purely honor system. This is, like I said, just another way to reinforce the material. But I strongly recommend you do take the quiz. Please don't just blow it off because it's not required. Take the quiz. It will really help you to cement this material. So you may have noticed that right below the video player, there were some downloads in this particular module. There is the week 1 quiz, and there is the week 1 quiz answer key. I would suggest, of course, that you download the quiz first, take the quiz, and then look at the answer key to check your work. Now, you have a couple of different options for how you want to take this quiz. Of course, if you have a printer and you want to use paper and pen, something like that, you can actually print out the quiz and take it that way. But if you would prefer to just do it digitally, you could simply download the file and using your PDF reader in Mac or a third-party PDF program in Windows, you can actually write or draw directly on the quiz. I'm going to show you how to do that for both Mac and Windows, starting with Mac. So the first thing you need to do, of course, is to download the quiz. And when you click this link, depending on your browser and your settings, it may prompt you to say, where do you want to download this? It might just automatically download it to your downloads folder or your documents folder or something like that. You'll need to know where the file gets put after you save it. But go ahead and save the file. And once you've done that, you'll need to open that file. Now on Mac, as I mentioned, it already comes with built-in support for PDFs. You don't need to add any third-party program or anything like that on the Mac. So just go ahead and double-click that file, the quiz, and it will come up like this. And you can see that they are largely multiple choice, but there are also some drawing questions. So, and also a few say it in your own words, explain, etc. Questions. So you can go ahead and go through these, and to do that digitally, if you prefer that way, what you can do is go up to the View menu and turn on Show Markup Toolbar. When you do that, this new toolbar appears here with a whole bunch of different drawing tools in it. And the probably simplest way to use this to check off your answers is going to be to click on this here, which is sort of a freehand pen-looking thing, and change the thickness of your line to, I wouldn't go too thick, that's probably a little bit too much, but maybe to something like this one will be just fine. And then maybe change the color to be black. And now you can just go and draw a little line for each one of the answers that you believe are correct. I'm just going to mark the first answer for all of these here. And then that way you know which one you chose, and then after you fill it all out, you can go through and check your work with the answer key. But now when you get down to the actual drawings, the chart drawings, well, they're on their side, right? They're sideways, so we need to fix that somehow. Fortunately, what we can do is when we're looking at that page, we can simply go up to, no, it's under View, it's under Tools, that's right. Go up to Tools, Rotate Left. So we want to rotate this chart counterclockwise. So I'm going to choose Rotate Left, and now just that one page rotates to the left, and now I can see all my chart looks correct. It's a little small, however, so what I'm going to do is I'm going to just go ahead and double-click on the header here, and depending on your computer settings, it may or may not go full screen, depending on what operating system you're running and so forth, but I think most likely it will go full screen. You could also always, of course, just grab the corner of the window and drag it bigger. But now you can see I've got a nice big chart. I can also hold down the Command key and type the minus sign. I can go Command minus, Command plus to zoom in, zoom out. It's also available here in the View menu, zoom in, zoom out, or zoom to fit, which will blow it up pretty much full screen. I'm going to zoom out one, maybe two more levels just to see it better. Okay, great. So now I have my chart. I need to draw on it. To do that, if I want to draw, say, a straight line, I can actually go into my Shapes tool here, and I can choose the Line tool. And it gives me a line. Now, by default, it's black, or actually, it's the color that I chose previously. I had chosen black for my pen in the earlier example. I'm going to change it to pink. Now I can just grab these points here. See these dots? I can grab those and move it where I want it. And let's say I was drawing a downtrend, something like that. And I can make it thinner too. If that's a bit too thick, I can just make it thinner. And maybe I like that a little bit better. And so let's say that that's what I wanted to draw. It was like, there's my downtrend. Okay, great. Now, what if I wanted to highlight some certain points on the chart? Well, I can grab my circle here, click on that, and I get a circle. And I can move it where I want it. Now, if by chance it were filled like this, if it was a solid circle, that's because there was a color selected here. This is the fill color. If I choose a different color, you'll see it changes the color. If I choose this one here, it's invisible color, or in other words, it's a hollow circle. So if that's what I want, just to circle key areas, I can do that. And let's say I was circling that area. And if I want to make another circle, I can either go grab the circle tool again and do it again, or I could just copy and paste this. I can go Edit, Copy, or type Command C, and then I can go to Edit, Paste, or type Command V. And now I get a second circle, and I can move it where I want it. I can go Paste again, I get another circle, and now I can move that there. Whatever areas I want to mark. If I wanted to mark the lower lows, I could do something like this, grab another circle, and maybe there. Whatever I need to do, that's how I can mark it up. And then I can go check the answer key to double check my work. And of course, I can scroll down, do the same thing for the second chart. And then for these here, where you're drawing a bullish engulfing or bearish engulfing, etc., again, you can use your simple drawing tools. I could use the line here if I wanted to draw the wick of a candle, let's say. And if I wanted to draw the body of a candle, I could do something like this. And I can shrink it down. I could fill it in. I could make it, green, for example. And if I don't like that pink outline, I can change that. I can make it green as well. I could make this line actually black if I don't want the pink line. There we go. And so now I've got a candlestick, and I can just move this around. And so, if you want to draw that way, you can. If I shift-click, I can hold multiple items and then move them together as a single object. Shrink this little line up a little bit. Whatever. You get the idea. You can draw simple shapes. This isn't a test of your drawing abilities. This is just to show, do you understand the basic general concept of what we're talking about in terms of the shapes of these candles. And then as far as typing an answer, if you want to actually do that, you can use the text tool here. Click on a text block, and I will get this text block. And if I go to the edges of the text block, see that? I get my hand. I can move this wherever I want it, and I can make it a little smaller. If that's too big, I can use this text settings here, and I can shrink the text down, and I can double click on this and just start typing. This is my answer to the question that was asked. And of course, I can then drag it over, make it smaller still, whatever I need to do. So that is how you can type directly on the quiz if you wish to do so. If you don't want to print it out, don't want to use paper and pen, something like that. But I recommend you go through the whole quiz, check it out, answer it to the best of your ability, then take a look at the answer key, see what you got wrong, and make corrections. And most importantly, understand why the answers are what they are. If you don't understand why the correct answer is correct, maybe go back, review the previous videos, or double check your material and make sure that you understand the answer that was given. If you still don't understand something, then definitely either go to the Facebook group, post a question there, or come on the Q&A call and actually ask me in person, and I'd be happy to help you to understand why the answer was what it was. Now let's talk about Windows. To do this in Windows, the first thing you need Adobe Acrobat Reader, because Windows does not come with built-in PDF support. Now, if you know how to do so, you're free to use other PDF programs as well. If you're an advanced computer user, this is going to be no big deal for you. But if you've not installed a PDF reader before, here's the easiest way to do it. First, just open up a web browser and do a search for Acrobat Reader. And somewhere in the top of the links, you should see this, something like get.adobe.com/reader. That is going to be the one you want, Adobe Acrobat Reader DC. Install for all versions. Click that, and you will be taken to an install page here. Now, before you just go clicking the Install Now button, I want to point out a couple of things. I'm not a big fan of this kind of thing, but Adobe piggybacks some additional software into your Adobe Reader install by default. That's what all these little check boxes are. It will install Google Chrome by default, a whole different browser. Like right now I'm using Internet Explorer. If you don't want Chrome to get installed, a whole another browser, you better uncheck that. And it also tries to make it the default automatically. And I don't want the Google toolbar, turn that off. And I don't want the Acrobat Reader Chrome extension, turn that off. So turn all of this extra junk off. And then click on Install Now. And now you have two options. You can either save the install file, save the installer to your computer if you think you might want to install this again in the future, or you can simply run it one time right now. I am going to go ahead and click Run, which then downloads the installer and runs it. So here it is. It's going to ask me if I'm okay with this because, of course, this was downloaded from the big, bad, evil internet. I'm going to say yes, I know what it is. I trust it. It's fine. And now it's downloading Acrobat Reader, Adobe Acrobat Reader, and installing it. All right, once it completes, you have the option to launch it right now. I'm not going to go ahead and select that because I'm going to show you something else. I'm now going to click Finish. And of course, it takes me to a page for Adobe trying to get me to take some free stock images, whatever. I don't care about that, and I don't care about this either. I'm going to close that. Now, wherever I downloaded the quiz, here it is. It is a PDF file, and now it recognizes that it belongs to Adobe Acrobat. So I can simply double-click it, and up comes the quiz. Of course, it has the answers, since I did this on the Mac already, and I didn't delete those first. So the Mac version automatically saves. It doesn't matter whether I hit save or not. If I make edits, they are automatically saved. The PC version does not do that. I would have to actually manually save. So let's just pretend like those weren't there because they won't be there on your quiz. And now, if you want to be able to mark your answers, you have a couple of different ways you can do that. Probably the easiest is to use this highlighter here. And you can just say, okay, I want to highlight. Just click and drag it, and then click and drag there. Scroll down, click and drag. Whoops, I chose two things. Whatever, you get the idea. Click and drag here, whatever. And so now I have highlighted my answers, make it very easy to see which ones I have chosen. But now what happens when we get to the drawings? So once again, by default, this will actually be rotated. So what I need to do is I'm gonna rotate it back to normal first. So it would look like this. I'm actually going to zoom out as well. Click these plus and minus symbols here. So it will look like this, but it's on its side. I need to rotate it counterclockwise in order to be the correct orientation. I'm going to go to View, Rotate View, Counterclockwise. There we go. This page is now rotated counterclockwise. And I could do the same thing for the next one, for example. This one here, I could say View, Rotate View, Counterclockwise. There we go. So I'm going to do this drawing on this chart since it doesn't have anything on it. Now, if I want to actually make lines and circles and so forth, they are not obvious anywhere. They're not up here on this menu. What you need to do is go up to View, Tools, and go to Comment, Open. And that gives you a whole host of markup tools. Now the highlighter rather, I'm going to click that to just deselect it. I don't want the highlighter. And now I have a bunch of different things. I can choose what I want to do. I can choose text boxes. I can, of course, just use the highlighter if I want. I can use a drawing tool here and make just arbitrary lines. I also have the ability to erase my drawings, but I also have shapes. And this is the one that most likely we'll be using here. I'm going to choose the line shape, for example. And now I can draw a line. So let's imagine here I was drawing an uptrend, let's just say. And let's say I was going to draw it from here to maybe something like that. Let's just say that that was what I wanted to do. So I click and drag, I end up with my line, and I can adjust things about the line. I can adjust its thickness here, make it thicker, and so forth. And you can adjust the color, the border actually of the line that I want to change. So there, now I have a green line. And I can do the same thing to make circles. I could go to my Shapes tool, choose the Oval tool here, and now I can draw some circles. I could maybe make a circle there, and then I could go grab another one and draw a circle, say, there, or whatever I want to do. So again, this is just to make sure that you understand what the general concept we're trying to get across here is. If your answer is not identical perfectly to the answer key, but you got the general idea, that's what we're after here. We're not after absolute carbon copying of the answer key. We're just after you got the gist, you got the general idea of what we're trying to communicate with this material. So once you go through, answer the quiz, fill everything out. By default, the Windows version, unlike the Mac version, the Windows version only rotates the current page you're on. The PC version, of course, did not do that, so I am going to have to rotate this back now. Rotate view clockwise. There we go. Now I can actually fill out the rest of my quiz. So that's how you would do this on Windows. And then again, once you have finished all of that, go ahead and download the answer key and take a look at it and just compare it to your answers and see how close you got. Again, if you have any questions, you don't understand why something is what it is, review the material, go back and double check. But then also, if you still are stuck or feel like you don't know, go to the Facebook group, post there, ask questions. And if all else fails, get on the call with me, ask me in person. I will be happy to help you out. All right, that's it for this module. Let's go ahead and move forward to the next one, and I will see you there.